Bismillahirrahmanirrahim, folks. This is Shahid Mehmood, research fellow, PIDE, Pakistan Institute of Development Economics, and this is a series of continuation of the series of one-on-one talks with eminent economists, eminent personalities of the economics field. Today we have someone with us whose blog and whose writings I've been following for some time. A very interesting person, especially when it comes to writings on economic history, especially monetary economics and macroeconomics. He has a prolific blog. He has it's called Uneasy Money. If none of you have ever heard of it, or so please do visit that blog. For anyone interested in macroeconomic issues, some of the pressing issues of economic issues of our time, and especially the monetary economics and economic history, economic history, please do visit, and please do read what David has written. So it's wonderful reading. It's wonderful reading. But before I go ahead and discuss other issues, discuss some of the issues that are of our concern for today's talk, let me just give you a short introduction to David. David received his BA and MA and PhD in economics from UCLA, where he studied under some of the giants of the field, like Leijenhoff, Klein, Hayek, Buchanan, Hirschliefer, Desmet, Alkane, and Thompson. His contact with Hayek and Buchanan was relatively brief, but especially with Hayek, it made great impression on him. His main interest in UCLA and subsequently have been area of monetary theory of macroeconomics, industrial organization, law and economics, history of economic thought, and the philosophy and methodology of economics. He taught at Marquette University in Milwaukee, Wisconsin for 5 years after graduating, before becoming a fellow at the Independent Institute, for whom he wrote his first book, Politics, Prices, and Petroleum. And then at the Manhattan Institute, where he wrote his second book, Free Banking and Monetary Reform, something that he has discussed a lot, even in his blogs, and has written papers on that. After writing that book, he became an economist for the Federal Trade Commission, where he worked since 1988 in the enforcement of antitrust competition laws. And while being there, he has published articles mainly on the history of monetary theory and macroeconomics and antitrust economics. He was the editor of a volume, Business Cycles and Depression, an encyclopedia published in 1997. And the collection of his papers were published in 2021 by Palgrave Macmillan. Its title is the History of Monetary Theory, Controversies and Clarifications. So, David, welcome to PIDE's talk. PIDE is a leading institute in the public sector. It's a leading think tank in Pakistan in the public sector. And recently, if we have this tradition of inviting people from different fields, especially from economics. We've had a few Nobel laureates coming over and talking to us. So it's a continuation of that effort, where we try to bring in different perspective from people within the field. So welcome, David. Welcome to PIDE's talk. I hope, and thank you for giving us time.
Well, thank you for inviting me, Shahid. I've recalled for a number of years our interactions on the blog and on Twitter, and it's always been a pleasure to have some exchange of ideas with you, and I'm glad now to finally meet you virtually in person. So thanks for having me.
It's a pleasure for us, David, and as they say, technology is a great equalizer. So you are sitting thousands of miles away from Pakistan, but here we are discussing some of the most important issues in the economic issues that confront us. Thank you, David. let's start our talk by one or two of the issues that that really are getting the limelight. If I propose, if I may say it in that way, one of them is, of course, the recent inflationary surge. You've seen interest rates go by central banks go up a lot. Few years ago, nobody would have thought that the Fed would raise its interest rate anywhere near even 2%, but now it's above. It's way above that. It's not way above that, but it's above that, and might even be going higher. In Pakistan, our central bank actually has increased interest rate. It now stands at 16%. So there's been quite a lot of talk of whether what central bank is doing would tame inflation. You seem to be your ideas on this have been on the other side of what somebody like Larry Summers proposes. Larry thinks obviously, and he has written a lot about it, that it's not transitory inflation, and it's going to take us somewhere higher to higher permanently. It's something of a permanent thing, but you tend to disagree. So can you take us through why you think like that, why you think that this is transitory? You've written a lot about it, so maybe you can take us through this.
Okay, I I'll try to give you a short overview of why I think inflation has been largely a transitory phenomenon, and why I think Summers and others like him and the Fed, which seems to be very hawkish on inflation, or have overreacted, at least to some extent. I think I think the source of the recent inflation is the extraordinary situation created by COVID, which led in the United States and in other countries to lockdowns in the first half of 2020, and the lockdowns were only gradually lifted over time. And I think one way to think about that is that it created a kind of a wartime economy, in the sense that instead of, in a wartime economy, you have a diversion of the labor force. This is like in a real major war, a world war, or an all-out war between countries, which leads to a diversion of the workforce from producing goods and services for the general economy, and diverts them into war-making activities, either in fighting the war or actually providing the material that's needed for the war. So what happened with COVID was that much of the economy, the civilian economy, shut down, not because of the war, but because of the fear of the disease. And as a result, economic activity was very much depressed. There was a huge drop in GDP in the United States. I think it was close to 25% in the second quarter of 2020. It gradually, the economy gradually started to recover in the latter part of 2020. But even in 2021, the economy was still operating well below capacity. So the government, the US government and the Fed had to confront a situation in which there was a huge decline in economic activity, and that the decline in economic activity meant the decline in incomes. So that was a tremendous hit to the economy, but the result would have been much worse if the government hadn't provided income support for the people who were not working and whose jobs had been lost and or whose businesses were being affected. That could have led to a cumulative effect of catastrophic cumulative effect as the entire economy was shut down because the economy could not have been continued to function normally. I mean, not even abnormally, but the effects would have become progressively greater. So by supporting incomes and providing monetary support, people were able to sort of ride out the interruption in economic activity without having their incomes decline, and so people had some degree of assurance that their entire livelihoods would not be irreparably harmed. So I think in that situation, providing economic stimulus to prevent a further decline was totally justified and necessary. But the result of that was that there was a large increase in cash balances that wound up in people's balance sheets. And they just were accumulating without really an opportunity for that income or for those the liquid assets, cash and other liquid assets to be spent, because the economy wasn't operating normally. So as the economy recovered, the question is, what should be done? What should have been done with the excess liquidity that was created in the process of supporting incomes during the pandemic, the worst part of the pandemic? So they could have imposed a contractionary policy to sort of drain out that those excess cash balances as they were accumulated, or they could just allow that to remain in the system and be gradually drawn down as the economy recovered and opportunities to spend on goods and services increased as the economy returned to normal. So the Fed and the government, the US government, took the latter course, which I think was correct. The result of that was inevitably going to be an inflation. And you see, after major wars, there's typically a major inflation after the war is concluded, because during the war, there is an accumulation of cash balances as incomes are increasing, because workers have to be paid, even if they're making war material rather than goods and normal civilian goods and services. So that's a typical post-war phenomenon, a post-war inflation. So there was going to be a post-COVID inflation unless the government and the Fed took a deliberately deflationary policy. That would have been a mistake. So a certain amount of inflation was sort of built into the system, and that was necessarily going to be a transitory phenomenon. On top of that, there were also supply side issues. We don't need to go into that, but that was a normal transition from this COVID economy to a normal civilian economy, and that was also bound to happen. So you had a series of a series of inflationary effects, but those were to be expected as the consequence of the consequence of the COVID economy coming back to normal. So that was happening in the latter part of 2021. And that situation was to some degree unpleasant, but it wasn't necessarily going to be an ongoing phenomenon. But that brings us to the end of 2021 and the start of 2022. And what happened at that point was the situation in Europe as Russia took an increasingly aggressive posture towards Ukraine, and that was a source of an additional inflationary effects that were added on to the inflationary effects of the post-COVID economy. Again, that's a typical wartime phenomenon. This is a more limited war except for Ukraine and Russia. For the rest of the world, that doesn't have direct inflationary effects, but there were important supply side effects on the price of oil and on food supplies, grain. Ukraine and Russia are major sources of grain for the rest of the world, so food prices were also affected. To sort of wind up the story, I think the inflationary effects were largely predictable, largely worth absorbing given the alternatives, and the aggressive anti-inflationary policies that Summers and was proposing, and that the Fed, after some delay, I think they probably should have tightened somewhat a little bit earlier, but not a great deal. I think that anti-inflationary policy, I think, has been overdone. And I think you can see the effects already because you have inversion of the yield curve. So now we have short-term interest rates are now substantially higher than the long-term interest rates. And that's usually a signal that that the public is expecting, that the markets are expecting tight monetary policy to continue, and that it's a signal that could lead to a recession if it's not, if the policy is maintained and not eased in the near future. And so I'm very concerned that the Fed has now taken the position that they have to keep raising interest rates until they actually see inflation coming down. Inflation is coming down, but they still seem determined to maintain the policy, and they're also concerned that there's not enough, there hasn't been enough unemployment yet to cool the inflationary pressures, which also seems to me to be a serious analytical mistake. We can pursue that if you want to, but I think I've said enough already.
Yeah, Dave, thanks. Yeah, you've explained it well. Just a few brief things, if I may ask you, and it doesn't have to be a long answer. You can just briefly, because in your blogs you discuss a few interesting things. One of the aspects the Fed's belief that the expectation anchor, or it has come off, right? So you tend to disagree with that. You say that no, expectations are well anchored, and as you said, that it's some kind of an analytical mistake or in their thinking that and expectations have become unanchored. Second, you how would you and briefly, a lot of people are making this comparison between the inflation in 1970s and now and say that it is the same, but you also tend to disagree with that one. So just briefly took us through these 2 points. Have inflation and is inflation really unanchored? Inflationary expectations, are these unanchored? And second, what's the is the comparison between the 70s, inflation in 70s and now? Is that right? Is that right or no?
Right. So there, for the last 20 years at least, there's been a concern about the unanchoring of inflation. And I think that has led to unanchoring of inflation expectations. And I think that led to bad effects that substantially contributed to the 2008 crisis, financial crisis. And I think also are contributing to the potential recession that we're facing if monetary policy remains overly tight. The bad effects of monetary policy don't always appear immediately, but I think there is certainly signs that it will have bad effects. The inversion of the yield curve shows, I think that's nearly definitive evidence that inflation expectations have not been unanchored. If they were unanchored, you would see a rising yield curve, not a declining yield curve. As for the comparison with the 1970s, I think a lot of the literature on the 1970s, and I've written this about on my blog as well, understanding the experience in the 1970s. In the 1970s, there were also very complicated effects, complicated sources of inflation. There were supply side sources of inflation, and there were monetary sources of inflation. And monetary policy in the 1970s was I think very badly implemented because monetary policy contributed to inflation in the early 1970s, and then there was the oil shock in 1973, late 1973, 1974, and that supply side source of inflation is not appropriately dealt with by monetary policy. And so the Fed was in the position of having created a first round of inflation by overly easing monetary policy in 1972 and 1973. And then after the oil shock in late 1973, 1974, policy was again tightened, was tightened excessively, which created a very serious recession in 1974, or exacerbated the recession of 1974. And then the scenario was repeated again in the late 1970s when you had both monetary policy that was inflationary, and then it was combined with another oil shock in late 79 and 1980. And again, the tightening in response to that was overly aggressive and led to the worst recession and the highest unemployment that the United States had experienced since the Great Depression. So, so I've gone on a little bit too long. So why don't I just leave it there, unless you have some follow-up.
No, you haven't gone on too long. It's good for our understanding, or for those who are listening and who would listen to this talk. So yeah, that's a very nice explanation of what's happening around in the world in terms of inflation. And the next topic that I would like to turn to and talk to you, and again, this is something that you've written a lot about, and it's in the news again nowadays, Bitcoin. You've written a lot about Bitcoin and touched upon cryptocurrencies. Just of recently, uh, it's been the collapse of the Bitcoin exchange, or the crypto exchange, FTX, and its owner if I remember correctly, Sam Bankman-Fried. He's been in the news, and then I think about a few days ago or a week ago, I read something about Bank of England analysis, which said somebody from Bank of England said that Bitcoin is on its trajectory to zero value. It's going to collapse in the future. It's going down. So, I mean, it's not good for those those who have been infatuated with this, and those who, from the very start of Bitcoin, believe that it's going to replace all the currencies, the fiat currencies, and all the monetary systems in the world, right? So, and you still find people who still cling on to that. I won't say fancy. That's a pretty strong word, but I would suggest that despite the precipitous falls in the values, we've had so many instances, we've had so many episodes where the Bitcoin goes up, and then there's a precipitous decline. It's kind of a people would say disaster. I don't know what the right word would be used to it, but how do you you've been writing about this, and one of the things that I found very interesting, to cut it short, you call it a speculative asset, right? You call it a speculative asset, and one of the in one of your blogs, you wrote a sentence which I found very interesting, and I'll finish my question at that the speculative attraction of Bitcoin as a speculative asset is a harbinger for its downfall, something like that. I don't remember the exact word, but it was something like that. And you cited the Gresham's law while
I didn't hear what did I cite?
You cited the Gresham's law. Gresham's law.
Yes.
Right? You did. So can you take the listener, can you take us through why don't you see it as something categorize Bitcoin as money? Why don't you see it like that? And why do you consider it just a speculative asset?
Okay, there's a lot to discuss there. Monetary theory has had a difficult problem explaining the value of money, and so it's one thing to have a commodity money. Commodity money already has a use value apart from its being money. So there's the famous paper that Karl Menger, the Austrian economist, wrote in the late 19th century about the evolution of money. And he explained that certain commodities because of the fact that they're more easily, we called it saleability, or at least that's the English translation, that saleability leads to a commodity being held not just for its own, or demanded not just because it's of the real services that it provides, but it's more convenient. It reduces transactions costs because it's easier to find that, use that in exchange. At any rate, that is the theory of the natural development of commodity money. Then the question is, well, we're no longer using commodity money. Silver and gold are no longer really used in transactions as a medium of exchange. So we use fiat money. So how do we explain fiat money doesn't have a real service? So how is it that fiat money comes into existence? So there are ways of explaining that, but the problem is, the problem with that is, even if you can say that fiat money has value, why do people continue to use it if they believe that it will? They believe that it will not. If they don't have confidence that it will continue to be accepted by other people, because it has no real use. So one way to deal with that problem is, well, if the government says that you must pay your taxes in terms of the money that we create, it does have a kind of a real use because you have to use it to pay your taxes. So that sort of and as long as the government is in power and is accepting it as a payment for taxes, so that creates a kind of a baseline for the value of the fiat money. But the question is, so what is Bitcoin? What does Bitcoin have going for it? Because aside from being used in a transaction, it doesn't seem to have any real usefulness. So the only way to explain that is its real value exists because people expect it to have some real value. And the problem with that is, even if they do have that expectation, that expectation is purely psychological, unless you can point to the real use that it's going to have. That's what I mean by it's a speculative asset. Now, there's a problem in explaining the value of speculative assets because there is the efficient market hypothesis, which says, well, the real value of any asset is based on its fundamental value. So if that's what you believe, then you have a hard problem with Bitcoin. Because what is the fundamental value? It's hard to really point to what the fundamental value is. Again, I'm just sort of listing the intellectual, theoretical issues that are all sort of revolving around this phenomenon. Rather than try to go more deeply into it, I'll just leave it there. You can. I have a paper that emerged from some of my writings on the blog that was published recently in a volume on Bitcoins, published by Edward Elgar. So you can refer to that, or you can go to my blog and see what I've written about Bitcoin. I'll just, getting back to the Gresham's law point, though, I'll just conclude with that. Gresham law says bad money drives out the good money. Usually that's interpreted in the context of fixed exchange rates. So if you have an overvalued money and an undervalued money relative to their real value, like this is in the context of a bimetallic system where silver and gold were both circulating, but there's a fixed exchange rate between the gold money and the silver money. So the bad money, meaning the money that's undervalued, in other words, the material value is less than the nominal value. So Gresham's law says the bad money drives out the good, because whenever people want to make an exchange, they'll always use the undervalued money in an exchange, and they'll keep the overvalued money. So I sort of generalize that point in the sense that if there are different monies, even if there are no exchange, no difference, even if there's no fixed exchange rate between the monies, and they're circulating in the same area, now I'll say the point differently because that's not where I want to go. If there are different assets that are being held, you're choosing between different assets. If the expected rate of appreciation of the monetary asset, whatever it's being used, is greater than the expected rate of appreciation of real assets, you have a problem, because people will not want to hold the real assets, they'll all want to hold money. If everybody wants to hold money, then the economy goes into a vicious downward cycle, because people think that the best investment they can possibly make is to hold money. So they want to accumulate money, they don't want to spend money. So it's suicidal for an economy to operate with a money that's expected to appreciate faster than other assets. So if people are holding Bitcoins because they think they're going to get rich holding Bitcoins, that's the last asset that you want to use as a medium of exchange. And it won't be used as a medium of exchange because it will only be held. It won't be exchanged. So that's why what I meant by Gresham, that's sort of an analogy to Gresham's law. It's not actually Gresham's law, but I think it's the same underlying idea.
Yep, that's a very good explanation of what you said. Somehow, my reading into this thing suggests that there won't be any shortage of people still vying for the Bitcoins and other cryptocurrencies, because they still believe that the fiat currencies are going to collapse.
Right. I think that there is this mindset that people of a particular ideological persuasion seem to regard fiat money as the curse of mankind, and they are looking for something that will some way of abolishing that system, and Bitcoin seems to be the answer to their prayers, and there's this emotional attachment to Bitcoin, which I can't explain rationally, but I have no particular prediction about whether Bitcoin is going to go down to zero, or if it will experience another revival, another appreciation, upward spike in its value. To me, it's just totally unpredictable, which is a bad thing for a money to not have a predictable value.
Absolutely.
thing that I will predict is it will never become a medium of exchange that's used widely.
Right, right. So let's move on to the next topic. And it's again, it's something that you've written a lot about. You already had, and you discussed it in your books and writings too. It's government versus private money. So I guess if you would briefly take us through your point of view about whether a government monopoly on printing money is good, on currencies. Is it good? Is it bad? What might be some advantages or disadvantages? And why don't we see private competing monies in action? So, for example, in maybe say in the United States, you had private institutions like banks, they printing their own money, which would be competing with each other, right, against the government dominated or the government determined dollar. So how would that? Why doesn't that happen? And what's your take on fiat currencies and how they've been used throughout history?
Okay, again, that's a very broad topic to discuss briefly, but I think it's important to talk about the difference between a monetary standard and who is actually creating the money. So I'm speaking as a monetary historian now, but I really am not sure if I am totally representing the history actually, but that's sort of convenient to think of it in the following way, that up until the 19th century, almost all monies were in some sense commodity monies. Or at least the standard was a metallic standard, commodity standard. And then in the 19th century, and especially in the 20th century, the standard shifted from gold or silver to a fiat standard. But even under the gold and silver standard, there were private institutions that were creating money that was convertible into the standard. The standard could be expressed within a country as a pound sterling or the French franc or the dollar. The dollar was represented a fixed amount of gold that was represented by the dollar. So even when there was private money creation, or by which you traditionally means a banknote, a currency with the name of the bank on the note, but it was still convertible at a fixed exchange rate. There was still a promise to redeem that in terms of the monetary standard, whatever the dollar represented. In the 19th century, if somebody was creating a banknote, a dollar banknote, it wasn't the standard wasn't created by the bank. The bank was simply promising to convert its liability, its IOU, into a fixed amount of gold represented by what the dollar was. So competing banks were never creating a monetary standard. They were simply creating their own debt, which was convertible into the monetary standard, whatever that monetary standard happened to be at a particular time. So I think the discussion of free banking and private note issue is a little bit misleading, because banks are still operating in the same way. They're still creating IOUs that are convertible into the monetary standard, except now, and even then, it was what they were creating was deposits. Some banks were creating banknotes, but most banks were not creating banknotes. Some were, depends on what the country was. Most banks were creating deposits, and these deposits were circulating as money in the sense that people were making exchanges. Over time, deposits became a more popular, widely used method of conducting transactions than banknotes. So I think when people talk about free banking as a completely different system than we have now, I think that's a little bit misleading, because banks are still creating money, except they're not creating money in the form of banknotes. They're creating money in the form of deposits, which are convertible into the monetary standard, which is whatever it is. It's no longer a commodity standard, it's a fiat standard. But banks are operating in more or less the same way that they always did, except they're not issuing physical banknotes, they're issuing deposits. Now, more and more people I used to write a lot of checks. Now I write very few checks, because most of my transactions are being conducted through my credit card or my debit card. So the banking system is evolving, but it's still, at least in the United States, most monetary transactions are being conducted through a medium of exchange, which is created by the banking system, not by the government.
Yeah, that's these are some, and again, it's unfortunate. Yes, it's a very broad topic and can't be just covered in even in an hour. I understand, but still, these are very wonderful insights into how private money or banks still are conducting the same thing as they used to, but we just don't realize that it's the same thing going on over there. But it's one can say that it's an evolution of IOUs that they are. Yeah, it's an evolution of IOUs that they indulge in. But yeah, thanks. Very nice insight on that. And perhaps later on, I can invite you to a webinar which will be exclusively dedicated to this very important topic, the fiat versus the private standard or the private money. But perhaps we'll have, and I intend to. And moving on to the next topic, because we don't have infinite time, so we'll go through a few more topics. I really wanted to ask you about, because being there in the States and staying there for around 6 years during completion of my studies, I'll tell you something honestly. David, I never expected something like 2016 to 2020 happening in the United States, where you had a populist leader with a lot of rhetoric. Should I say fiery rhetoric, coming to becoming the president of the United States and being there for 4 years. Ultimately, he was pushed out. I wouldn't say he lost because he was pushed out. Until the very last, he refused to accept the election results. So I was just wondering, how do you see his rise, and what might be some of the consequences of populist politics? And I'll just briefly explain why I'm asking this question, because we are seeing something like that in different parts of the world. You see populist rise in Brazil, in other parts of the world, and even in Pakistan, we just had a populist leader. So what are some of the economic consequences of populism that you can see?
It's hard for me to answer that, because I'm so much more concerned about the political consequences populism, and I share your dismay at how we used to think as a very stable form of government in the United States has been so weakened over the last 6 or 7 years because a demagogue became so successful in rallying a populist movement to his in support of him, and he retains such a significant, they call it a base, that's such a such a large segment. It's not necessarily a majority, but it's so intense and it's so large relative to the political party, the United States Republican Party, that basically that party cannot, that party has been effectively captured by this populist movement. And now the recent events in the United States, the unexpectedly bad performance of the Republicans in the midterm congressional elections, and the ongoing investigations into likely criminal activity by the former president, have reached such a level that there seems to be a lot of angst in the Republican Party, but that would somehow like to turn the page on this this episode, but it's not clear that they're able to, because the following is so committed. The core supporters are so committed to the leader that they can't. There's no effective mechanism for replacing him. So I think that they're just looking at it from a narrow economic perspective. Most economists deplore the nationalistic approach, nationalistic protectionist approach of that Trump imposed on the party, which for a long time was a free trade, or at least advertised itself as supporting free trade. In practice, the political system never tolerates a principled free trade policy. That would be a whole other topic to discuss. But the orientation and the rhetoric was in favor of free trade. Now the rhetoric is largely, if not exclusively, protectionist and against immigration and all sorts of international forms of cooperation. And you see this the same phenomenon in different forms in European countries. So it's a very, for me, it's been a very depressing period of time, and it's hard for me even to be optimistic about the future. But one hopes that that somehow things will get better. But so on that topic, I'm afraid my comments fairly disorganized and can't at least in a short. I can't compress them into a coherent answer in a short period of time.
I wouldn't say they are disorganized. I think you've answered that question very well. Just in addition to it, the reason that I asked, as I said, the reason that I asked this question is because there is kind of a wave of populism going on around the world, and a lot of populists are getting elected. And and again, one thing that I noticed was, and I asked you about the economic consequences, that these kind of populist movements tend to undermine institutions of a country, and institutions, as in institutional literature on economics, as we come to know, they are of a lot of importance, of utmost importance. So, but anyway, David, he did teach us something new, didn't he? That George Washington took over the airport in 1776, didn't he? I had never heard of it, really. So it was something new for me. I had read American history, but I never knew about that one.
He likes to say about himself that nobody knows more about blank than I do. And obviously nobody knows more about military history or about aviation history than he does.
Oh, well, I hate to say it, but here's something revealing for you. We had one populist leader who used to say the same, and I know more about people of a country than anybody else. But I won't go further into it because his proponents or his supporters then get angry. But you just interestingly, you just talked about, and since you are at the Federal Trade Commission, so a quick question. Again, it's a very broad topic, but just a brief overview or just a brief answer would do. You've been at the Federal Trade Commission. How do you see, how do you view free trade or trade with little restrictions? Because, and again, I'm asking this question because there have been some. In fact, there is now a lot of research. I'm forgetting the name. Perhaps it was David Otter, the labor economist, or one of his colleagues. I don't exactly. Perhaps it was David Otter, but who suggested that trading with China has been a kind of a disaster for the United States, and that's one of the things that Donald Trump used in his election campaigns. A lot of rhetoric was built on that. So, how do you view that? How do you view trade with little restrictions? What's your point of view?
Okay, so just before I try to answer that, since you mentioned that in your introduction, that I have been at the Federal Trade Commission for over 30 years now, I should make the disclaimer that whatever I've said so far and anything that I will say after this does not represent the views, does not necessarily represent the views of the Federal Trade Commission. So I've been speaking completely for myself, and nothing that I've said should be attributed to the position of the Federal Trade Commission.
Understood.
So I'll also make a clarifying comment that the responsibility of the Federal Trade Commission is the enforcement of primarily the enforcement of antitrust law, competition law, also various forms of consumer protection, such as misleading advertising and other consumer protection issues. The Federal Trade Commission has no responsibility for international trade. So we don't make any regulations. The Federal Trade Commission does not have any responsibility for enforcing any laws pertaining to international trade or international trade policy. So again, now speaking purely for myself on the issue of free trade and protectionism and those sort of issues, my inclination is in general, very much to be supportive of free trade and against trade restriction. Since you followed my blog very diligently for these years, you may recall that I once wrote a blog entitled "What's So Great About Free Trade?" That was like maybe 2014, 2015. I'm not remembering exactly, but that article about the effects of trade with China on American consumer, or its effect on the United States, I think may have played into that blog post. I'm not remembering exactly whether it came before or after I wrote the blog post, but in any case, what I did in that blog post was kind of a critique of the way economists think about trade. It wasn't meant as an argument against free trade, but the point I was making there was that the way economists do welfare economics, and the way they do, so just the way in which they think about what economic welfare is, how to think about economic welfare, misses a lot, and it's hard to put that into these other factors which are missing from the economic analysis, are hard to put into an economic analysis. But what I was referring to is that what makes people happy or what improves welfare in economics is ultimately how much people are consuming. It's their total amount of consumption. That's what determines welfare. And I think that's a mistake, because I think what people get satisfaction from is really what they're doing, not what they're consuming. Well, I shouldn't say what they're consuming is certainly an important part of it, but it's certainly not all of it. And what people do, what their social relationships are, whom they interact with, the work that they're doing, how they're spending their time. Most of the time that people spend is actually working, not consuming. So that all of that seems to be missing from economic models. And I think that means that economic models are not really capturing a lot of what real people really care about. And I don't have a good recommendation for how to fix that. But I think that is really a large gap in economic models, is that all of those things which really affect people's well-being and their happiness, their psychological, are people depressed or are they happy? I think a lot of that doesn't, whether people are depressed or happy doesn't depend as much on how much they're consuming as how they're getting along with other people. And to the extent that free trade can result in communities that are dependent on a particular industry can result in those communities essentially dying because the industry that was supporting those communities, the activity in that industry, I think that's really very problematic. And I don't know what the appropriate economic policy response to that is, but I think I don't think we've thought enough about that or thought about it in an economic context. And so I think that leaves an opening for populist ideas to it creates an audience for populist ideas that just want to arouse the resentments of the population against the system that makes economic transition, economic change possible. That's sort of the creative destruction phenomenon that Schumpeter talked about, and which economists think is an important aspect of economic development, but it creates a downside, which we also have to try to address. Again, I'm just pointing that out. It's not that I have a solution or a recommendation about how to make our analysis more relevant and more useful.
Yeah, that's for an introductory talk on for just an introduction on free trade and its advantages. I think that would do. And as you said, that these are pretty broad topics that cannot be just covered in a few minutes or 10 or 15 minutes. But that's pretty much what you said is pretty much the gist of it. It does provide us into an insight, and a very good insight from a welfare perspective. So if you have time, David, just a few more questions before I let you go and don't disturb you anymore. Would that be okay? Just a few more questions.
My pleasure. Thank you, Shahid.
One thing that I really found interesting in your blogs, and you've written several blogs about it, Milton Friedman and his ideas. You don't seem to be a big fan of Milton Friedman. In one of your blog posts, where you also mentioned Don Patinkin's views on Milton Friedman, and then you talked about his lack of proficiency in monetary history. His, maybe if I remember correctly, you said his obsession with the real bills doctrine.
Sorry,
and that
could you repeat that? His obsession with
the real bills doctrine.
Oh, yes.
Right, the real bills doctrine. So maybe I'd be a bit near so that you can hear it clearly. And you also, if I remember correctly, you also said something about his poor knowledge about the pre-Keynesian monetary theories, like that of Cassell and Hartree. So how do you overall, Friedman, what was, how do you view his stature as an economist, as a monetary economist specifically? Was he too obsessed with the supply side of money? Or was it, were his theories just a reorient or rewording of what had been presented earlier? What was he? What's he in your eyes? What's his stature?
Yeah, that's an interesting question. Most of what I've written on my blog about Friedman has been negative. It's interesting that when I was a student, I was a great admirer of him, and it took a long while for me to start questioning questioning a lot of what he had written. It's sort of it's hard for me to summarize my views about him now in just a few sentences. So first, I'll acknowledge that he was really a very fine economist. He had very good insights. He had a very good ability to marshal evidence, relevant evidence for his theories, and to see the implications of economic analysis, the empirical implications of economic analysis. So I want to give him his due. I don't think he was a bad economist. I think he was a great economist, but I think he had many shortcomings, and I think he very ideologically driven, and I think he wanted to arrive at certain results, and I think that's true of most economists, but I think it was true of him a little bit more than is true of most economists. So you always have certain predispositions, and this is people have this confirmation bias. They start with opinions and like to interpret the evidence in a way that supports their opinions rather than causes them to have to revise their opinions. So that's sort of a general comment, but so my more specific comment about his monetary theory was that he made various historical representations about economic and monetary theory, which I think were not well founded, which were the result of gaps in his own knowledge of the history of monetary theory. And there was a certain superficiality in his arguments. And once he found a certain way of thinking that supported his ideological position, it was very hard to move him away from that. He eventually did acknowledge that his favored monetary policy rule wasn't working, but it took him a very long time before he reached that conclusion. And as I studied his monetary history of the United States, I saw that in a number of respects he didn't understand, his theoretical understanding was deficient, and that led him into bad arguments in the monetary history. The particular one that the particular instance of that misunderstanding was his assumption that changes in the quantity of money in the United States were the exogenous force that generated the Great Depression. And he completely ignored the larger international context having to do with the restored gold standard of the 1920s and the effects that were taking place as a result of the gold standard, and how those were impinging on what monetary policy was in the United States. And I think his entire discussion of the Great Depression in the monetary history is misleading, highly misleading, because he didn't understand the role of the gold standard, and that became his treatment of the his treatment of the Great Depression and the monetary history, like became the the high point of his history as a monetary, his reputation as a monetary economist, because he came up with the explanation of the Great Depression. He didn't come up with the explanation of the Great Depression. He came up with a very partial and misleading explanation of the Great Depression, which left out the most important part. And yet that is the pinnacle of his achievements, was to have explained the Great Depression. So I find that a sort of bad economic history on his part, and also a lack of attention to explanations other than his own, monetary explanations of the Great Depression other than his own, which he should have been aware of, but ignored and did not give any credit for. And so in all respects, I find that to have been an episode that was not, that doesn't redound to his credit as a monetary economist, and it doesn't redound to the credit of the economics profession for having given him such accolades for that deficient explanation of the Great Depression.
Right, David. Yeah, that's a I guess that's a good explanation of why where you differ from Friedman and where you differ from a lot of people who see him as a perfectionist, if I may say, in terms of monetary history and monetary economics. And to be honest, I agree with a lot of what you said, not just because of what you read in what you stated in your blog, but in considering and observing some of the monetary phenomena back in my country too. And obviously, then there is the monetary history of which we were talking about. But anyway, one last question. I understand that you might have to leave, you might have other obligations. You've already given a lot of time, for which I'm thankful. What are some of the recurring ideas in monetary history or monetary economics? You've written about it. So if you can enlighten the listener, I mean, in terms of policy making, especially, what should the policy makers in terms of monetary economics or monetary policy what should they keep in perspective?
I think, just to follow up on the Friedman discussion, I think I could just mention a couple of points. One is that the money supply is determined endogenously. You shouldn't be looking at the quantity of money as being an accurate measure of the stance of monetary policy. Friedman liked to say you shouldn't look at the rate of interest as a measure of the stance of monetary policy, and I would say you shouldn't look at the quantity of money as an accurate measure of the stance of monetary policy. Monetary policy is difficult, and it's hard to find any single indicator that tells you whether monetary policy is too loose or too tight. You have to look at take a systemic view and take into consideration a lot of different variables. And that's why monetary policy is more of an art than a science. One of Hawtrey's, one of his most famous books is The Art of Central Banking. And I think that's how I understand it. You can't just look at one simple number, which was what Friedman was suggesting, and say, well, that tells you whether monetary policy is too easy or too tight. Another example of that is the idea that that monetary policy affects only one country. Monetary policy is international in scope because money is an internationally traded commodity. So the quantity of money doesn't, in the United States, doesn't only affect prices in the United States, it affects prices throughout the world. Because the United States, the US dollar is the dominant international currency, and it's the dollar is sort of the benchmark for every other country. There used to be a gold standard. There's now a dollar standard. Not everybody, that doesn't, even countries that aren't pegging their exchange rate against the dollar are adjusting their monetary policy based on what the United States is doing. So the United States is in fact the Federal Reserve is the central bank in a very important sense for the entire world. I actually don't have my list of 8 recurring ideas in front of me, but I think those 2 would be enough for now. We can come back to the other 6 perhaps on our next conversation.
We definitely will, David. It's been a pleasure talking to you. And as I said, I've been conversating with you through your blog over the years. But
I
finally,
appreciate
we did
your many comments.
Yeah. So, and I've learned a lot, and I'm still learning. Whatever you write, it's very insightful. Unfortunately, time is not infinite. We have other commitments too, but this isn't the end of it. I'll be talking to you again. There is a lot more to discuss in terms of macroeconomics and monetary history, monetary economics. So I'll let you go at this, but thank you so much for talking to us. Thank you so much for being at PIDE's platform. We'll be inviting you again, whether it's a webinar or one-on-one talk. But whatever you said, whatever we talked about, I hope you enjoyed our interaction. And
yes, it was great talking to you, and thanks for having me.
Thank you, David. You have a nice one, and we'll be meeting again. Thank you.
Thank you. Look forward.